Why should you, as an everyday investor, care about tariffs? Not because they're abstract government policy buried in headline jargon, but because they quietly raise the prices you pay, squeeze company profits, and can shrink the value of your investments. In short, tariffs don't just happen in Washington or Beijing. They show up in your grocery bill, at the checkout counter, and inside your portfolio balance. Tariffs are like a stealth tax stitched into almost everything you buy. That new phone, the washing machine in your house, even groceries can carry hidden tariff costs. And the companies paying those fees at the border, they don't usually eat the bill. They push it down the line until customers and investors like you end up footing it. In this video, I'll break down what tariffs are, how they ripple through the economy, and the chain reaction they trigger across stocks, ETFs, bonds, and commodities. More importantly, you'll walk away with practical steps: how to protect your portfolio, where to find opportunities, even in a trade war, and how to turn what looks like political noise into an investing advantage. Stick with me until the end, because tariffs aren't really about politics. They're about defending and growing your wealth in a market shaped by global trade tensions. But first, this video is for informational purposes only and is not financial advice. I'm not a licensed financial advisor. You should do your own research and consult with a qualified professional before making any financial decisions. Hey, welcome to the Trading and Investing Hub. I'm Alex, and today we're talking about how tariffs affect your investments. Let's start with the foundations. A tariff is simply a tax that a government imposes on imported goods. Imagine a toll booth at the border. When a shipment of foreign steel, electronics, or clothing enters the US, the importing company pays that toll to US Customs. Notice what's important here is not the foreign country that writes the check, it's the American importer bringing the product in. Now, once the company has paid the tariff, it faces three choices. 1, it can absorb the cost itself, which reduces its profit margins. 2, it can pass the cost along to consumers by raising prices. Or 3, it can scramble to find a new supplier outside of the tariff-impacted region. Economic research tells us that in practice, most firms take option 2. Studies by the National Bureau of Economic Research and the New York Fed have shown near-complete pass-through of tariffs into domestic prices. That means you see the extra cost at the checkout counter, and businesses avoid carrying the burden themselves. This dynamic makes tariffs inherently inflationary. There are two main types of tariffs to understand. A specific tariff is a fixed fee on each unit imported. For example, a tariff of $20 per ton of steel falls under this category. On the other hand, an ad valorem tariff is calculated as a percentage of the value of the good. So if a laptop costs $1,000 and there's a 10% tariff, that computer suddenly costs an importer $1,100 to bring in. The distinction matters, but the outcome is the same for you as a consumer: higher costs on goods. Why do governments use tariffs? The motives usually fall into three buckets. First, protection of domestic industries. By making imports more expensive, tariffs give local producers a competitive edge. Second, political leverage or national security. Leaders sometimes use tariffs as tools to pressure rival nations or to protect industries considered vital, like defense technology or energy. Third, and historically the first reason, raising government revenue. Before the modern income tax, tariffs were a main source of federal funding. History gives us some dramatic examples. The Tariff Act of 1789 was one of the first laws passed by the US Congress, creating a 5% tax on most imports. It was a critical source of revenue for a young government without an established tax system. In 1913, the Underwood Tariff Act lowered tariff rates significantly and introduced the federal income tax, which shifted how the government raised money. Fast forward to 1930, and you see the infamous Smoot-Hawley Tariff Act. It raised duties on more than 20,000 imported goods. Other nations retaliated, global trade collapsed, and US imports and exports fell by more than 40%. Many economists believe these policies deepened the Great Depression. For a retail investor, these aren't just historical trivia. They show a repeating pattern. Tariffs change the flow of money in the global economy, create winners and losers across industries, and sometimes pull the entire market downward. Even if you never trade a single share of a steel company or a farming cooperative, the shockwaves of tariffs hit the broader economy you invest in. So, while tariffs may sound like distant government policy jargon, they're really an invisible tax that shifts costs, drives inflation, and alters where profits land. And because the modern economy is deeply interconnected, those shifts show up in your investments, whether it's higher input costs for companies in your stock portfolio, reduced consumer spending that drags on earnings, or the price of imported goods that affect inflation and bond markets. That's the big idea. Tariffs start at the border, but they don't stop there. They travel through supply chains, into prices, through company earnings, and finally into market performance. Understanding that chain reaction is the first step to knowing how tariffs directly affect not just companies or countries, but your personal investments. Here's where tariffs stop being a policy term and start reshaping how the economy works day to day. The first thing you need to know is that tariffs have a direct and measurable effect on prices. Multiple studies, including research from the National Bureau of Economic Research and the Federal Reserve, show that when tariffs are imposed, nearly all of the cost lands squarely on U.S. consumers and businesses. Economists call this a near 100% pass-through, which is really just a technical way of saying that companies don't eat the cost. They raise prices. So if a tariff adds a 10% tax on imported washing machines, the final sticker price for you as the buyer rises by roughly 10% as well. That constant pass-through makes tariffs inherently inflationary, and we can see evidence from recent history. During the 2018 to 2019 US-China trade war, researchers estimated households faced an extra $1.4 billion in lost real income every single month. Think about that for a second. Every month, collectively, US households were effectively paying an invisible price tag just because tariffs pushed import costs up. Inflation, even if it's only a fraction of a percent at first, compounds across millions of products and turns into real economic pressure. Inflation is only part of the story. Tariffs also act as a drag on economic growth in the bigger picture. Economic modeling from places like the Wharton School projects that broad, long-lasting tariff regimes could cut the size of the US economy by anywhere from about 0.5% to as much as 6% in the long run. Even a smaller, persistent reduction of 0.5% translates into $100 to $180 billion in lost annual output. That's not just an academic data point. That's fewer jobs created, weaker wage growth, and tighter margins for the companies you're likely investing in. When we zoom in on the job market, the ripple becomes clearer. Politicians sometimes frame tariffs as job savers, raise tariffs on foreign steel, and suddenly US steel mills look more competitive. But in practice, the net effect tends to be negative. Why? Because for every one job in steel production, research shows there are roughly 80 jobs in industries that consume steel, like construction, automotive manufacturing, or machinery. That means protecting a handful of steel jobs can end up raising input costs for much larger industries, forcing layoffs, slowing hiring, and shrinking profit margins. The picture gets more complicated when you consider retaliation. Tariffs rarely go unanswered. Trading partners respond with their own penalties directly targeting vulnerable US industries. Agriculture provides a textbook case. During that 2018-19 trade conflict, retaliatory tariffs on soybeans, pork, and other farm products led to an annualized loss of about $13.2 billion in US agricultural exports. For farmers, that wasn't a headline about geopolitical strategy. It was reduced demand, unsold crops, and disrupted communities. And for investors, that meant downward pressure on agricultural businesses, regional banks serving rural areas, and companies tied to farm supply chains. Now let's talk about supply chains, because this is a major way tariffs reshape the economy. Global industries, especially technology and retail, rely on complex webs of suppliers. When tariffs make one pathway too expensive, companies don't just absorb the pain, they restructure. In the height of the US-China tensions, an estimated $165 billion in annual trade had to be redirected. That meant sourcing from new countries, renegotiating contracts, and in some cases moving production entirely. Those moves take time, cost money, and introduce new risks. For retail investors, that shows up as volatility in earnings reports, unexpected hits to margins, or even opportunities when companies successfully diversify supply chains to lower tariff regions. Tariffs don't exist in isolation. They accelerate inflation by passing costs directly to consumers. They drag on GDP growth by making economies less efficient. They hurt job creation in industries that consume more than they produce. They invite retaliation that can crush export sectors, and they force expensive supply chain rewiring. Each of these factors doesn't just impact abstract economic indicators. They filter directly into the performance of companies and industries within your portfolio. So when you see a tariff headline, don't dismiss it as political noise. What it really represents is a chain reaction touching inflation, growth, jobs, trade balances, and supply chains. And those are exactly the elements that determine whether the assets you hold in stocks, ETFs, bonds, or commodities thrive or struggle during tariff cycles. Next, we'll step into the investment side of the equation to see how different asset classes respond. Now let's bring it down to what really matters for you as an investor, how tariffs spill into different asset classes you might already hold. We'll look at stocks, ETFs, bonds, and commodities because tariffs don't just move one corner of the market, they cut across everything in your portfolio. First, let's focus on stocks. Stocks are the most direct way tariffs show up because they affect company revenues and costs. Start with the obvious losers, companies that rely heavily on imported parts or finished goods. Think about large retailers that stock their shelves with products primarily sourced from abroad. When tariffs hike the cost of those imports, retailers either raise prices, which can hurt customer demand, or eat into their profit margins. Either outcome drags on earnings and pressures stock performance. Technology companies also land in the crosshairs. Most big tech firms depend on global supply chains with components sourced from Asia. Tariffs on chips, circuit boards, or manufacturing services quickly ripple into higher costs that are hard to avoid. Exporters face another challenge. If a company sells a big chunk of its goods in foreign markets, it can be directly targeted by retaliatory tariffs. That's why U.S. farmers and equipment makers struggled during the U.S.-China trade conflict, as those goods became more expensive overseas and demand dropped. Not all stocks are losers, though. Some companies are insulated from global trade. Utilities are a prime example. Local electric and water providers generate nearly all their revenue domestically and aren't relying on imported inventory. Whether tariffs rise or fall has almost no direct impact on their core business model. Waste management firms are another example. They operate regionally, serve essential needs, and are basically shielded from international trade tensions. These are the so-called domestic champions. Their resilience makes them attractive in tariff-heavy environments. There are also special cases where tariffs can act as a tailwind. Take the steel industry. If foreign steel is slapped with high tariffs, domestic producers suddenly face less competition and can raise prices. Companies like major U.S. steel producers sometimes benefit directly. Just remember, the net effect across the economy is negative, but at the company level, some pockets can win. Now think about ETFs, because most retail investors use them to diversify. Defensive sector ETFs, like funds that bundle utilities, consumer staples, or healthcare companies, tend to be resilient in tariff periods. These sectors provide services and goods people rely on regardless of trade policy, making their earnings streams steadier. Then you've got geographic diversification ETFs. Here's where tariffs may actually open opportunities. With the China +1 trend, global supply chains are moving into countries like India, Vietnam, and other parts of Southeast Asia. International ETFs tracking these markets can be positioned to pick up growth as companies redirect their sourcing and investment flows. So even as one country faces pressure, investors can access expansion elsewhere through ETFs. Moving on to bonds, the relationship with tariffs gets a little trickier. Remember, tariffs push prices up. That's inflation. And inflation erodes the fixed income payments bonds provide. When inflation expectations rise, bond yields tend to climb and bond prices fall. So in a tariff-driven inflation environment, your bond holdings may take a hit in value. But at the same time, bonds, especially high-quality government bonds or top-tier corporates, often act as safe havens during periods of uncertainty. Investors may buy treasuries because they're considered a reliable place to park money, even if yields don't keep up with inflation. The safe haven effect can balance some of the losses from inflation, making bonds an important stabilizer for diversified portfolios. Still, you need to pay attention. Tariff shocks can change how bonds trade. If you're building a bond allocation, look at maturity length and quality. Shorter duration, higher quality can provide more stability when inflation risk ticks higher. That brings us to commodities. This is another area where tariffs have real bite. Take energy and minerals. When tariffs discourage imports of critical resources, domestic extraction and production may benefit. Companies focused on U.S. oil, natural gas, or metals can see higher demand as industries source locally. On the flip side, agriculture is one of the most vulnerable commodity sectors. Because it's such a common target in retaliatory measures, farmers often experience direct reductions in export demand. When your target market imposes tariffs on soybeans, pork, or corn, U.S. exports fall, and with them, revenues. That trickles into agricultural equipment makers, seed suppliers, and rural economies tied to farming. So commodities become split. Some gain from tariff protection, others take painful losses. Now let's connect the dots. Tariffs don't hit every sector and asset the same way. They create both risks and resilience. Stocks in global industries often suffer, while domestic service providers escape relatively unscathed. ETFs give you tools to go defensive or open geographic opportunities. Bonds can be pressured by inflation but provide calm during storms. Commodities experience their own divide. Energy and resources may gain, while farm exports decline. Tariffs reshape where growth and resilience reside in the market. They reward companies insulated from global shocks and penalize those tethered tightly to international goods flows. As a retail investor, your edge comes not from predicting every tariff headline, but from structuring your portfolio so it can withstand the crosscurrents. And that's why the next step is so important. If tariffs create this pattern of winners and losers, we need a practical strategy for positioning, so that even if trade wars heat up or tariffs expand, you have a framework to protect and grow your investments. That's what we'll dive into in the next section. So now that we've walked through how tariffs ripple across stocks, bonds, ETFs, and commodities, the obvious question becomes, how should you, as an everyday investor, actually respond? Let's be clear. Tariffs might dominate the news cycle when trade disputes heat up, but if you yank your portfolio back and forth every time a new tariff is announced, you'll end up chasing headlines instead of building long-term wealth. The smarter approach is to arm yourself with a framework that works in tariff-heavy environments without forcing constant reactionary changes. The foundation of this framework is simple. Stick to your long-term strategy. Market history shows that disciplined investors who avoid chasing short-term noise come out ahead. Tariff headlines may cause volatility, but volatility is not the same as permanent loss. If you view your portfolio through a 3, 5, or 10-year horizon, individual tariff announcements fade into the background. The first temptation every investor faces during trade flare-ups is to sell out of fear. The problem is, by the time you react, the market has likely already priced in the tariff news, and the next move can just as easily be up. Tuning out that noise protects you from knee-jerk mistakes. The second principle is diversification, a word you've heard 1,000 times, but here's why it specifically matters in a tariff environment. Tariffs hit unevenly. Some sectors like utilities or waste management stay resilient. Others like agriculture or consumer electronics suffer. If your portfolio is overweight in one of the exposed areas, you'll feel the pain. But with a diversified mix, losses in one pocket are often balanced by gains in another. Think about diversification on 3 levels. Geographic diversification means you don't bet entirely on one economy. If tariffs hurt US-China trade flows, having exposure to markets in India, Vietnam, or Europe gives your portfolio an escape valve. Asset class diversification is the next layer. Stocks represent growth, but bonds often play defense. Even though tariffs can nudge inflation up and pressure some bonds, high-quality treasuries or corporate bonds typically still attract demand when uncertainty rises. Finally, sector diversification rounds out your defenses. Cyclical areas like tech and discretionary retail might wobble, but defensive sectors like healthcare, consumer staples, and utilities move with steadier demand. Blending these elements builds portfolio resilience against trade-induced shocks. The third principle is looking for tariff-resilient companies. You can think of resilience here as 2 things: insulation and adaptability. Insulation comes when a company earns most of its revenue domestically and relies little on imported inputs. For example, a waste services company that works entirely within US metropolitan areas doesn't see international tariffs touch its operations. Adaptability shows up in companies with pricing power. Strong consumer brands with loyal customers often have the ability to nudge prices higher without losing demand. If tariffs raise production costs by 3%, these firms quietly pass through a price increase and keep margins intact. The last key element is financial strength. Companies with healthy balance sheets, low debt, and strong cash flows can handle short-term shocks far better than highly leveraged peers. Tariffs often disrupt supply chains and costs. Firms with solid buffers can weather those disruptions without risking solvency or dividend cuts. To make this practical, here's a 5-part checklist you can use when evaluating a stock in a tariff-heavy climate. First, revenue exposure. Does the company earn most of its sales domestically, or is it heavily reliant on international markets that could retaliate? Second, supply chain exposure. Are critical parts sourced from tariff-affected countries? Third, input costs. What are the raw materials the company depends on, and would tariffs make them more expensive? Fourth, pricing power. Can the company feasibly pass increased cost to customers, or is it stuck eating the difference? And fifth, balance sheet strength. If earnings dip temporarily, does the firm have the financial stability to ride it out? When you run through these questions systematically, you take tariffs from being a vague macro risk to a tangible checklist you can apply in stock selection. The last piece of the framework is psychological. Tariffs, because they're headline-driven, tend to create bursts of fear and uncertainty. You'll see volatility spikes, hot takes, and predictions of market doom. But the reality is, while tariffs cause friction and redistribution of growth, they are not an existential threat to long-term investors who maintain discipline, diversification, and quality. Train yourself to read tariff headlines, not as time to panic, but as signals to revisit your portfolio checklist. More often than not, calm discipline beats rushed reactions. That's the framework. Tune out noise, diversify on multiple dimensions, and seek resilient companies. By grounding your investing in these principles, you protect yourself from both the direct inflationary effects of tariffs and from the psychological traps they set for unprepared investors. And once you're armed with that structure, you can move to the next question. How do you actually position yourself to not just defend against tariffs, but to spot opportunities others missed? When tariffs make headlines, many investors focus only on the risks, but tariffs actually create an environment where some categories of investments quietly gain strength. The key is to know where to look. One group to watch is domestic service champions. Utilities and waste management firms hardly notice trade wars because their revenue is local and demand stays steady. For investors, that means dependable cash flows when globally exposed companies are wobbling. Another category is protected producers. Take US steel companies. They can see a direct benefit from tariffs on foreign steel, since reduced competition allows domestic players to raise prices and hold market share. Energy and natural resource companies that operate largely within the US also fall into this category. If tariffs discourage energy imports, domestic suppliers stand to benefit. Geographic diversification through international ETFs adds another angle. Countries that attract China plus one supply chain shifts, like India or parts of Southeast Asia, can become winners as multinationals reallocate production. ETFs focused on these markets let retail investors capture the upside of changing trade patterns without needing to pick single companies abroad. But opportunities don't mean you should ignore risk management. Tariff policies can change rapidly with elections, global negotiations, or political bargaining. That means you never want to load up too heavily on one theme, even if it looks promising. Instead, size positions modestly, recognize that conditions may reverse, and always balance them with defensive holdings. In practice, this means avoiding overexposure to sectors most vulnerable to retaliation, like agriculture, export-heavy industrials, or consumer discretionary retailers dependent on low-cost imports. The art is in balancing risk and reward. Capture some of the resilience or upside without betting the farm. And that brings us back to the individual investor's perspective, where the real advantage lies not in chasing news-driven moves, but in applying a consistent, disciplined framework that makes tariffs one challenge among many, not the one that derails your plan. Here's the takeaway you should hold on to. Tariffs are not abstract policy tools happening somewhere far away. They're hidden taxes that flow straight into higher consumer prices, lower corporate profits, slower economic growth, and more fragile global supply chains. For investors, that chain reaction matters. It shapes sectors differently, penalizing exporters and import-reliant industries while leaving room for domestically focused and tariff-resilient companies to shine. Recognizing those patterns gives you a real advantage. The key is not overreacting to every headline. Tariffs will rise, fall, and sometimes vanish depending on the political climate. What matters is building portfolios that don't stand or fall on one trade relationship. That means following the framework we covered. Diversify your geography so you're not tied to a single economy, balance asset classes to offset volatility, and make sure you hold a mix of cyclical and defensive sectors. Then overlay that with careful stock selection. Analyze whether a company has mostly domestic revenue, strong pricing power, and a balance sheet solid enough to weather disruption. Approach it this way, and tariffs shift from being a threat to being another factor you already account for. So if you remember one line, let it be this. Tariffs shift costs, but with the right strategy, they don't have to shift your wealth. Subscribe for more practical investing insights, and stay tuned for future breakdowns on other market topics that help you protect and grow your portfolio.